Stocks can be a valuable part of your investment portfolio. Owning stocks in different companies can help you build your savings, protect your money from inflation and taxes, and maximize income from your investments. It is important to know that there are risks when investing in the stock market. Like any investment, it helps you understand the risk-return relationship and your own tolerance for risk. In this video, we'll show you the 7 top stocks that you can buy in 2022. It's a harrowing time to be a growth stock investor. Even the mega-cap tech companies have started to tumble, while more speculative and unprofitable companies have absolutely imploded. To be fair, there were some indefensible valuations in certain growth stocks. In some cases, analysts extrapolated a short-term surge in demand far into the future, leading to impossibly high expectations. Now, however, things are rapidly moving in reverse, and opportunities are really starting to emerge. Nowadays, even the highest quality software stocks are trading down sharply, and there are absolutely stunning declines in some of the smaller and less established growth firms. Here are 7 of the best growth stocks to buy that still have the ability to deliver big returns for investors. Number 1. Honeywell International. Honeywell is an industrial conglomerate that specializes in aviation, building automation, industrial process automation, and other industrial materials and equipment. Honeywell is an attractive value stock with multiple growth vectors. A slowdown in N95 mask demand may weigh on safety and productivity solutions growth in the near term, but the segment will still be the biggest contributor to Honeywell's long-term growth. It is predicted that Honeywell's 5-year compound annual revenue growth rate will be in at least the mid-single-digit percentage range. Morningstar has a buy rating and a $230 fair value estimate for Honeywell International and a $230 fair value estimate for Honeywell International Incorporation stock, which closed at $193 on March 21. Number 2. Adobe Systems. Adobe is a company that notably shifted from a one-time license model to a recurring subscription-based model years ago. This initially caused a great deal of concentration among investors and analysts, but have proven to be wildly successful. Adobe generated $7.3 billion in revenues in 2017. That's a tremendous growth rate for a company that is already as large as Adobe. In addition to Photoshop and Illustrator, the company has resembled a wide array of other pieces of key software. Some, like Acrobat, have served as a launching point for a broader cloud-based app ecosystem. With the industry in a downturn, Adobe is now in a position of strength to make further acquisitions and grow its overall market share. Number 3. Autodesk. Autodesk is in a related field to Adobe. It also makes software primarily for managing images and graphic design. However, the difference is that Autodesk is more focused on industrial applications, whereas Adobe is the leading brand for purposes such as media and advertising. Autodesk allows companies to plan out models of products, factories, building blueprints, and so on. Autodesk is moving into other fast-growing fields, such as 3D printing. Autodesk stock has pulled back from $330 to about $215 per share since November, offering a solid discount for investors today. Number 4. Netflix. Netflix remains an unparalleled leader in video streaming. Its catalog of content is second to none in terms of quantity, especially for international and foreign language content. This has given Netflix an incredible leg up in terms of expanding in places such as Europe and Latin America, whereas other American rivals are half a decade behind in terms of trying to broaden their non-English libraries. Netflix's global sourcing allows it to find unexpected hits, such as the recent Squid Game, from all over the world. However, like many stay-at-home winners, Netflix has slumped as new memberships have slowed down. Many people who were going to sign up for Netflix already did so during the pandemic. Netflix stock has tanked in 2022 as investors' factor is slowed down. With shares down 35% per year to date, this is a great entry point for longer-term investors. Number 5. Spotify Technology. Spotify is for music, when Netflix is for movies and TV shows. And Spotify stock has taken a similar blow this year as investors factor is slower near-term subscribers growth. Spotify is also investing in platforms such as podcasting, advertising, and virtual event hosting to lessen its reliance on the record labels. The crux of Spotify's portability problem has been that it pays out majority of its revenues to the labels. As it diversifies its revenue streams, however, it should be able to keep more of the pie for itself. Spotify is arguably in an even better position than Netflix, since Spotify has little competition to worry about aside from Apple. Over time, Spotify should be able to consolidate the music streaming market and improve its profit margins. Its current market cap of just $30 billion is rather undemanding for such a powerful brand. Number 6. Lightspeed Commerce. Lightspeed Commerce operates a cloud-based point-of-sale system. It competes in the same general arena as rivals such as Spotify and Block. In addition to general retail and e-commerce, Lightspeed has services for more specific applications such as restaurants and hospitality. When the pandemic hit, Lightspeed appeared to be a big winner out of the gate. Shares railed tenfold as businesses rushed to adopt digital checkout services. Since then, however, Lightspeed stock has lost 3/4 of its peak value as investors fear a slowdown in the e-commerce space. That will probably happen, but the stock price has likely overreacted to the concern. The company's market cap has now fallen to about $4 billion. That's not expensive at all for a firm with approximately $550 million of run rate annual revenues. Number 7. Canada Goose Holdings. Not all growth companies have to be in the technology sector. Luxury winter clothing maker Canada Goose has been one such rapid growing firm. Though the firm was founded in 1957, it has come into its own over the past 5 years. In 2016, it generated about $220 million of revenue. This soared to $719 million for fiscal year 2021. While Canada Goose continues to grow, its profit margins got hit in 2021 and the stock has slumped 40% year over year. But analysts still see double-digit revenue growth going forward. As profit margin recover, analysts see earnings per share jumping to $1.24 in 2023, which would put the stock at less than 22 times forward earnings. That's all for this video. I hope you enjoyed it. Let us know your thoughts in the comment section below. If you haven't already, then don't forget to subscribe and press that like button. Also hit the bell icon so you can never miss new updates from us. Stay safe and we'll meet you in the next one.